Every quant researcher knows the drill: read a paper, form an intuition, clean data, code a factor, run a backtest, and then stare at a curve that either disappoints or looks too good to be true. Now imagine a machine that does all that in seconds, generates 1,000 new factors a day, each with an impressive equity curve. That is the seductive promise of AI-driven alpha mining. But speed amplifies statistical debt. A machine that can test 1,000,000 hypotheses can just as easily churn out the world's most efficient overfitting production line. Examines the logic behind automated factor discovery, dissects 5 hidden risks that turn raw ideas into statistical mirages, and presents a professional pipeline with 7 gates that every credible quant workflow must pass. Traditional quantitative research is a constrained search. A human analyst relies on economic reasoning, decides which variables to look at, in what frequency and combination, and then uses data to eliminate wrong hypotheses. The bottleneck is attention and coding speed. An AI, by contrast, can scan hundreds of academic papers, map dissimilar concepts into a unified factor suite, test thousands of arithmetic combinations, and log every result automatically. Projects like QuantAlpha and AlphaSage, each with slightly different emphases, all aim to shrink the cost of moving from hypothesis to experimental feedback. If this model holds, research throughput might increase by an order of magnitude. The promise is not that the AI is smarter, but that it can explore the search space far more exhaustively than any human team, potentially catching interactions among volatility, liquidity, and trend that would otherwise be overlooked. Here is the first and most pervasive risk: multiple testing. Assume for a moment that all the factors your system generates are pure noise, completely unrelated to future returns. If you test one random factor at a 5% significance level, it has a 5% chance of appearing significant purely by chance. That means about 1 in 20 will look like a winner. Now let the AI loose. It tests 1,000 noise factors. According to this simple identity, you will get about 50 seemingly significant findings. From those 50, a human or another algorithm will naturally pick the ones with the highest Sharpe ratios and the smoothest curves. The backtest equity curve hides the number of failures, and thus hides the true probability that the result is luck. The more you test, the more your best result is just a lottery ticket that came up this time. This chart makes the inflation effect concrete. At just one test, the expected number of false positives is a trivial 0.05. Run 100 tests and you expect 5 false positives. At 1,000 tests, you get 50. At 5,000, you get 250. These are not accidental discoveries, they are the unavoidable arithmetic of hypothesis testing. Now imagine a researcher who only shows you the top 5 curves from that 5,000 test batch. They look brilliant, but they are less meaningful than a coin flip. The professional solution is a research ledger, a mandatory log of every hypothesis tested, every parameter range tried, and every discarded result. Only when you know the denominator, the total search effort, can you discount the winners appropriately. The second risk is data leakage. AI-generated code runs fast, but it rarely understands the true release time of each field. It might standardize on the full sample before splitting into training and testing, use future-adjusted index constituent lists, or assume that end-of-day prices are available before the close. When these mistakes happen, the backtest gives no error message. Instead, the curve becomes extraordinarily stable, because the model has been allowed a look into the future. In quant finance, the most dangerous program is not the one that crashes. It is the one with a logical flaw that produces a smooth, high Sharpe equity curve. Automated research therefore demands deterministic code audits and data unit tests, feature timestamps must precede signal timestamps, transformation parameters must be learned only from training data, and a gap must separate the label from the features to prevent overlap contamination. Risk number 3 is factor redundancy. An AI system may produce 100 factors with different names and arithmetic forms, but in truth they are all betting on microcap, low liquidity, or short-term reversal. Examining each in isolation makes each look like a new discovery. Placed in a correlation matrix and a risk model, they reveal themselves as the same old exposure dressed in a new formula. Before any candidate factor enters a live portfolio, it must pass a suite of incremental tests, correlation clustering, style neutrality, industry neutrality, and an assessment of how much new information it brings on top of the existing signals. The question is never just, is this factor good on its own, but rather, does it add something I do not already have? Alpha is not the number of factors you own, but the amount of non-overlapping information they carry. Risk number 4 combines transaction costs and capacity. Many automatically generated factors favor complex, high-turnover expressions because they fit historical noise more easily. But turnover brings a suite of real-world costs, bid-ask spreads, commissions, market impact, and taxes. The more concentrated the signal, the more crowded the trade, and the lower the capacity. A beautiful zero-cost backtest may look nothing like reality once you plug in realistic slippage. This chart shows how a hypothetical AI factor producing 12% annualized excess return in a frictionless world crumbles as costs rise. At just 10 basis points per side, the return drops to 8.5. At 25, it turns negative. For any systematic strategy, the professional workflow must model not just return streams, but turnover, cost sensitivity, and capacity constraints. To internalize the cost lesson, consider this simple break-even formula. The net return you actually capture is the gross alpha you find minus the product of turnover, single-sided cost, and 2, because you pay both to enter and exit. If a factor generates 5% gross but turns over the portfolio 10 times a year, and your realistic cost is 10 basis points per side, then the cost drag is 10 times 10 times 2, which equals 2 percentage points. Your net return falls to 3%. Raise turnover to 20 and costs to 20 basis points, and the entire 5% gross vanishes. Before trusting any AI-generated factor, run this arithmetic under stressed assumptions. A factor that does not survive a cost sensitivity grid is theoretical investing, not a tradable signal. The fifth risk is market regime decay. A factor's efficacy exists because of some behavioral bias, institutional friction, or risk premium that prevailed in a particular market environment. But regimes change. Liquidity tightens, volatility structures shift, participants adapt, and what was a reliable premium can vanish or reverse. Testing a factor on a single fixed split, say 2010 to 2021, tells you nothing about how it performed during the tightening cycles of 2022 or the volatility shocks of 2025. The solution is not a smarter backtest window, it is a rolling, walk-forward framework that reveals how the factor's information coefficient, return contribution, and turnover evolved across distinct macro regimes. Furthermore, you must predefine entry and exit rules, deciding under what conditions you would stop trading the factor, before the equity curve starts to break, rather than searching for explanations after the fact. Several statistical tools exist to help a researcher own up to the search effort. One is the deflated Sharpe ratio, which explicitly takes the observed Sharpe, the number of observations, and the number of trials conducted, and shrinks the estimate toward a more honest value. Under this framework, a Sharpe of 2 based on 5 years of daily data and 10,000 independent searches might deflate to something much closer to noise. A companion metric is the probability of backtest overfitting, or PBO, which estimates how likely it is that the best performer in sample will rank poorly out of sample. Neither statistic makes a bad strategy good. But they force the uncomfortable recognition that the more you test, the more you should doubt your best result. No AI can relax this. 1,000 CPU cores simply mean you must be 1,000 times more suspicious. If you were to design a professional automated alpha pipeline from scratch, you would set up 7 gates, and nothing reaches a live portfolio until it passes all of them. Gate 1, candidate generation, where AI's role is broad but each idea must still justify itself with an economic story and clean data requirements. Gate 2, a static audit that flags overcomplexity, timestamp errors, and suspicious duplication. Gate 3, a research sample that tests directionality without fitting parameters to perfection. Gate 4, independent validation using dynamic intervals with explicit statistical penalties for the total search. Gate 5, robustness checks across different stock universes, time periods, and cost assumptions. Gate 6, portfolio increment, demonstrating that the factor provides genuinely new information beyond existing signals. Gate 7, Simulated live trading, where paper execution on real-time, executable prices reveals the true impact of capacity and signal decay. This pipeline runs on discipline, not hope. The central tension of AI-driven alpha mining comes down to a single principle: a machine can expand the hypothesis space 100-fold, but it cannot lower the standard of proof. A backtest is a compressed, selective memory of the past. Live trading is an open book exam administered by a market that does not promise to repeat its historical patterns. The most dangerous institutional mistake is to let the same optimization process that proposes a factor also set the validation rules and change the scoring grid. In any credible quant workflow, the entity that generates the candidates must be separated from the entity that grades them. Automation is not about replacing human judgment, it is about accelerating the exploration while keeping the gates of falsification firmly in place. We have traced the arc from promise to pitfall. AI-driven factor discovery can vastly improve the productivity of a quant team, but it also concentrates the risk of statistical deception at a scale no human researcher could match alone. The 5 risks: multiple testing, data leakage, factor redundancy, cost and capacity blindness, and market regime decay, are not new, they are the eternal companions of empirical finance. What AI changes is not their nature but their velocity. A 7-gate pipeline that enforces economic reasoning, static auditing, statistical discounting, robustness, incremental contribution, and simulated execution is not an impediment to innovation, it is the only structure that prevents the research engine from turning into an overfitting factory. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.